Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. What's happening with the US dollar? What's going on with the yen? I'm going to show you how we are experiencing a historic devaluation, not only between these two pairs, but with currencies in general. Let's begin by taking a look here. Yen slides to 24-year low against the dollar. So of course we can measure two currencies together and see them in relation. The US dollar is the reserve currency of the world. It has this monopoly in the way that all commodities happen to be priced in US dollars. It gives it an advantage. If two countries want to do business between each other, they first must buy the reserve currency to then do trade. Now, things are certainly changing here, but that's generally the way business works. Everything that you look at, if you want to go buy some gold, you're technically buying it in US dollar. Many people don't realize that. You look at what has happened with the yen. Now, this is so interesting. The yen plunged to its lowest level against the dollar since 1998 on Monday, as sky-high US inflation fuels a widening monetary policy gap between Japan and the world's largest economy. So Japan is saying we are going to print until the yen is confetti. People are going to be buying it at the dollar store to be throwing here and there at parties. That's the intention here. Whereas the US central bank, the Federal Reserve, is saying what we are going to do is we're going to tighten monetary policy and we're going to make sure that inflation gets into check. So, what is going on and why is this the case? Well, if you look at inflation and the money printing and of course the stimulus packages, what has happened here all along? Well, we have witnessed the dilution of the currency. And it's hard to tell if all countries are doing it roughly at the same pace. But when one starts to get out of whack with the other, you encounter this. And so you can see the Japanese yen spot looking at this over this period. I mean, by the time you're watching this video, who knows where it is, but it has certainly weakened from where it was over the past several years. So this chart goes back to 1980. And then we look at what happened here. I mean, clearly from, it's hard to tell on here, maybe 300 to the US dollar to, in a relatively short period of time to, let's say, where we are today, around that 130, 135 area. Big change, right? And so this begs the question, what happens to investors? Well, investors start to flee. Why? Because now they're able to attain much more yield from their bonds. You go and buy a US bond, you're going to get a higher yield than you would in other countries. And even we've seen other countries, I mean, remember the negative yielding debt? That was crazy, but it was all over the place. Not so anymore. But as they say right here, 10-year Treasury yield rockets above 3.39% in the biggest move since March of 2020. So what's happening here? Well, you're watching the US debt in this case here becoming much more attractive, more money to flow in. And that right there tells you what's going on in the markets. Very different situation. This right now just shows us that the Bank of Japan is printing the Fed equivalent of $300 billion a month. You don't see that too often, right? Monthly JGB purchases showing us that we are at an extreme level right now. So they are just going pedal to the metal still. They need to change course. And if they do so, well, then they encounter other problems, you see? So they have backed themselves into a corner, and we see how chaotic this can really be. Benchmark 10-year Treasury yields hit their highest level since 2011 on Monday, and a key part of the yield curve inverted for the first time since April, as investors braced for the prospect of the Fed's attempt to stem soaring inflation that will dent the economy, okay? Inflation up, central banks got to raise rates. You see the point, okay? So this tells us right now what we are encountering. But what happens to assets in this period of time? Well, I'm going to show you that. I'm actually going to get into what's happening with the Federal Reserve, and I'm going to show you many different indicators here in this video. So stick with me. Today, investors face a dilemma. Inflation is at the highest point in 40 years. The Fed is going through a phase of aggressive monetary tightening, and top firms predict stock market returns under 5% until 2035. Restructuring your portfolio has never been more difficult or more crucial. So, where can you turn? Well, a recent JP Morgan report declared, quote, alternative assets are no longer optional. In light of this new normal, certain platforms have arisen, giving access to the top alternative asset classes, and there is one that is particularly interesting to me. It's called Masterworks. Masterworks has solidified itself as the platform for investing in contemporary art. They let you access their exclusive investments from names like Banksy, Monet, and other iconic artists for just a fraction of what the billionaires pay to purchase, because roughly 2/3 of billionaires allocate between 10 and 30% of their overall portfolio to art, in part to diversify and because it's a natural inflation hedge. It makes sense after all. Contemporary art prices outpaced the S&P 500 total return by 164% from 1995 to 2021 and have exhibited the lowest correlation to equities of nearly any major asset class. Since inception, Masterworks has sold 3 paintings, with each returning over 30% net of fees to investors. Of course, past performance is no guarantee of future results, but 30+% is quite impressive. My subscribers can actually skip Masterworks' waiting list by going to masterworks.art/themoneygpsmw. Economists say the Fed will stick to 50 basis points this week. Powell will open the door to more aggressive actions later. So by the time you're watching this video, maybe that decision has already come out. The two options basically are 50 basis points and 75 basis points. The base case here, 50 basis points. But regardless, when you see the Fed's activities, understand that this is the most important factor to what happens not just with the US dollar, but the economy as a whole. Now, I want to talk about something that I thought was incredible. This article, believe it or not, written in The Atlantic, had just really woken something up inside of me. A light bulb went off. Consider this simplified example. Let's say that the ingredient, labor, and transportation costs of a pizza delivery in New York City averages $20. If the company charges $25 for the average New York City delivery, it will make a profit. But if a startup charges $10 for the same thing, it will lose money, but get a lot more pizza orders. More pizza orders means more total customers, which means more overall revenue. This arrangement is tailor-made for a low-rate environment in which investors are attracted to long-term growth more than short-term profit. You've seen it all before. They give the examples in here. It's Uber, it's, Airbnb, whatever it is. As long as money was cheap and Silicon Valley told itself the next world-conquering consumer tech firm was one funding round away, the best way for a startup to make money was from venture capitalists was to lose money acquiring a gazillion customers. And so many different companies did do this. And many were successful in the end, right? I could look at, just take the example of Amazon, where they were so, everyone was saying for the years and years and years, they're never making money, they're never making money. Well, then they made a lot of money. It took a long time. Many companies do not make it to that point. I call this arrangement the millennial customer subsidy. Now the subsidy is ending. Okay, they talk about, interest rates, the Fed, and so on. Rising interest rates turned off the spigot for money-losing startups, which, combined with energy inflation and rising wages for low-income workers, has forced Uber, Lyft, and all the rest to make their services more expensive. You see? You see what's happening here? I knew all this, obviously, and I'm sure you did too, but seeing it like this was really good for me. Meanwhile, global supply chains haven't been able to keep up with the domestic consumer demand. That'll change soon, which means delivery times for major items like furniture and kitchen equipment have bloomed from 3 to 5 days. And sometimes between this fall and the heat death of the universe, so on. That means higher prices, higher margins, fewer discounts, longer wait times. For micro generation of yuppies used to low prices and instant deliveries, the golden age of the bougie on-demand urban tech discounting has come to a close. Now we will see if that's actually the case. But the point here is that things are changing with a lot of companies. It's not just the Ubers of the world. Do you see what's happening here? They need to work on their profits or they will shut down. When they shut down, nobody's shedding a tear. But trust me, the people that work for them are not going to be too happy about it. 1980s era rate hikes designed to fight inflation will create more market turmoil. So you see this all the time, looking at the central bank, their activities having a direct impact on the markets. Right. But some markets will do better than others. Some markets will be able to withstand this. The most liquid markets usually take the hardest hit. That's a fact. Why? Well, people, oh, I need that. I lost. Okay, let me harvest some of those losses. Let me take this. I'm going to cut that. Okay, you're gone. At the same time, you want to trim the winnings. Okay, so a lot of these companies are doing that. But then there's illiquid assets that doesn't trade hands very often. You see that with physical gold. How often does physical gold trade hands? I mean, come on. How many countries have you seen requesting their gold? Who was it recently that was trying to request their gold from the UK? It was like 5 years later, still not happening. Okay, physical gold. You've got art, very clear. Talked about that many times before. That's not trading hands very often. And then you look at real estate. When I say real estate, I'm talking about multi-family real estate. Multifamily, like 300 units, 500 units, all in one. That's multifamily. How often does that trade? Very rarely. Okay, different situation. Those illiquid assets do not have the same cycles. It's important to know that. Look at this. Market bottom signs, market top signs. Now, if I read all this to you, you're going to fall asleep. Link will be in the description under the sources. You can see this right here. Just cover a couple. Looking at corporate, almost no mergers and acquisitions for market bottom signs. However, when you see a market top, there's a wave of mergers and acquisitions, leverage buyouts. You look at low quality IPOs. We saw 100 of those. What about when we're at the market bottom? No IPOs, no share buybacks, right? Now, when you have a market top, you got all crazy share buybacks. So these things right now are really, really informative. Take this, use this, have that knowledge. I think it's important for a lot of people to understand the depths of what we are going through. There will be growth afterwards. I don't know when that's going to come. I don't know when, things will turn over and get better. I mean, there's short term, there's long term. But we must be prepared in every way that we possibly can. I'm trying to do my best to bring out the information that you need to know. Okay? If you support this, simply hit that thumbs up button. I created a new channel. It's right down there. Have you seen it? That channel is like 20 to 40 second clips where I condense information down, take one simple point, bring it to you each and every day. And you can get that right down there. First link in the description, okay? Or I'll put that maybe at the bottom. This will be right at the bottom, in fact. So you can get that if you're interested. And that's basically it. If you support the channel, hit that thumbs up, and I'll see you on the next one. Take care.